welcome to the first Indianomics edition of 2025, where we have done a special poll for you to map out how Indian macros may shape up. First up, the poll says the Indian rupee will slide to 86.25 by March 2025 and further to 87 by the year end. That's, of course, according to a poll of over a dozen economists and treasury heads. For the year end, the economists' forecasts are lie between 86.75 and 87.5. GDP growth is on an average seen at 6.4% for FY26, but the range is 6.3 to 6.5, while for FY26 next year, the growth is seen at 6.6%. The range again is 6.5 to 6.8. Finally, for inflation, the current year is seen averaging 4.8, which is basically the Reserve Bank's forecast. But for next year, the poll shows the CPI may average at 4.4. Well, that's the poll. For a more nuanced discussion on how the economy will pan out, what we may expect from the budget and monetary policies, I'm joined by B Prasanna, the head Global Markets Group at ICICI Bank, Kaushik, Cheif Economist at Deutsche Bank, and Upasna Bhardwaj, Chief Economist at Kotak Mahindra Bank. Gentlemen and Upasna, thank you very much indeed for joining me. Well, Rupee is uppermost in the mind, Prasanna. So the first question is fired at you. You know, one thought when I did the poll at 86 quarter, and I did the poll late last year, around December 30th, it looked like 86 quarter by March end was okay. But the slide thereafter and the sharp rise in the dollar index to almost 108.3, do you think the weakness can be even more in the first half of the current year?
So, good morning, Latha, and good morning to my co-panelists and your viewers as well. So, I think slide is a very strong term, Latha. If you really look at the percentage depreciation of the rupee against the dollar, and especially when you compare it with various other currencies, it's much, much lesser than what some of the other currencies have experienced. So, while I do agree that the rates have depreciated a bit, you can call that the dollar index has actually appreciated substantially. It was just at 100.5 before the Trump trade started, sometime in September 30th or so. And after that, we have seen nearly 8.5% appreciation of the dollar, and hence depreciation of most of the other currencies. Rupee has performed relatively better than most of the other currencies. Having said that, what we do feel is that, unfortunately, we do feel that the dollar strength will possibly continue for at least a month more. And I think all of the fears of the Trump trade and the policies, whether it's on tariffs, corporate tax cuts, equity growth, inflation, as well as the fiscal deficit, all of that is getting factored in. Now it remains to be seen as how much of it is reality and how much of it is just fear. And accordingly, I think after the next 1 month plays out, the dollar will possibly either peak out and then react to the actual announcements by the president when he takes office.
Okay. No, I'm sorry if I gave you the impression that slide is a negative thing. On the contrary, I would think that we ought to be shoulder to shoulder with at least competing exporting countries, because already we, even before the Trump trade began, there were steel companies complaining to us that China is dumping, they are selling at below cost, with the renminbi depreciating already at 7.3. Okay, just tell me that. What are you all expecting in terms of renminbi depreciation? And therefore, should we be wanting and preparing for a cheaper rupee? Rupee has depreciated 3% in 2024. Should it not be at least 3% in the current year as well?
Is that to me, Latha?
Yes, to you, Prasanna.
Yeah, I think our house view is for yuan to depreciate to something like 7.5, and depending upon what kind of tariffs come, we take it forward from there. And on the INR bit, I kind of also agree with the kind of poll results that you've got, which is that we are into a depreciating scenario. RBI will step in to kind of, measure the volatility a little bit. But I think the sense that dollar INR goes higher, the rupee depreciates is a given. So I would say that around 86 to 86.5 by this fiscal year end, and December end, maybe close to 87.5, I think is something that even I would subscribe to.
Okay. Well, let me get the growth dynamics in, and then coming back to you for interest rates and the bond index and the bond levels. Upasna, you have only a 6.1% for the current year, a little lower than the range of my expectations for FY25. Why are you factoring such a low number? Are you worried about domestic consumption faltering?
Latha, yes, I think we are looking at most of the indicators and they are suggesting that consumption is likely to remain extremely weak, and private sector capex too is not picking up at the pace at which we have been, anticipating. It's a rolling expectation that we've been holding on to for the private capex. So none of the two private sector categories primarily are expected to hold up. At the same time, if I look at the center plus state spending, that too is not picking, especially on the capex side. It's still not picking up pace, the pace at which we were expecting. The third quarter has passed by, and now we are left with the last quarter. What we need to keep in mind is the kind of excessive welfare schemes that the states have been announcing. And in order to meet their 3% overall targets, FRBM targets, they will have to compromise on spending somewhere else. And in that context, I think capex could still not be taking so much of a lead. So I guess somewhere all of this together, it's a more broad-based expectation apart from agriculture. We're looking at a reasonable slowdown across the board. At the same time, we need to keep in mind that last year, H2 was 8.2% average, and it is a very high base. So on that, we are looking at H2 of 6.2%. A little here and there, but broadly, yes, that is going to be there. Assuming that there are no changes to the number, of course, we might be seeing changes, but there, of course, I don't want to speculate there.
Yeah, fair point. Though, of course, the GVA number was lower, but yes, you have to contend with that 8.2% number. Let me come on that point to you, Kaushik. You are actually the optimist in our group. The poll we did, at 6.5, hardly any adherence to that number, except the Reserve Bank, which stands at 6.6. Where is that confidence stemming from? The auto sales numbers that we got for December were not very encouraging. GST at 7.3% higher seems to be indicating Q3 is not all that good. What's your sense?
Hi, Latha. First of all, Happy New Year, and
Thank you.
Happy New Year to your viewers as well. We knew that the second half of the fiscal year, there would be some pickup in growth. Also, we have built in the possibility that FY24 8.2% growth will probably be revised lower. So that will also give some, kind of support to the base. And all taken together, government spending, will increase more than the first half that we have seen. Already, we have seen some increase in momentum in October, December. Numbers could be, biased. The risk could be biased to the downside, but all taken together, I think we could come to 6.5% growth for FY25. But whether we are at 6.3, 6.5 for this year or next year, also we are at 6.5. The main point is we are going to be below the potential growth rate of the economy, which is at 7% or higher. And that's what we need to focus on. The numbers we can keep on quickly because it changes.
I agree. I completely take your point that, that is the larger question that both policymakers and citizens should be squabbling about. But I still want to ask you whether there's a downward bias to your Q3 number. What is the Q3 GDP number? And having looked at what we've got, lead indicators, auto sales, GST numbers, etc., credit growth, are you likely to give a downward bias? What's the number? What's the bias?
So Q3, October, December, we have a forecast of 6.8% GDP growth. And I think RBI, if you've seen the latest monthly bulletin, they're also saying that currently the nowcasting is showing around 6.8% for October, December. Now, obviously, the quarter is not over yet. We'll get more data, and along with that, we'll make up our mind whether to reduce it. But as I told you, on February 28th, when we get the October-December GDP number, it'll come with a lot of revisions. So all these forecasts may not mean much. But I think we can go above 6.5% in October-December. Private consumption should pick up more, given what we have seen in October. The festival demand and government consumption on the margin would have picked up from the first half of the fiscal year. Kharif sowing has been good. So if you plug in all this together, and corporate earnings may not be as good as what we have seen in the past few quarters, but definitely better than July, September. That is the expectation. We should be above 6.5% growth in October, December. We have around 6.8. Whether it is downside bias, we have to decide by the end of the quarter when we get all the numbers.
No, I take your point that there's a lot of FMCG companies telling us that, rural recovery is good, and even tier 3, tier 4 cities are showing some spunk. But I don't know about the nowcast of the Reserve Bank. They said that even in, when they gave us the October bulletin. And 6.7 was their nowcast. We ended up with 5.4. So the nowcast perhaps does not have all the data. Anyway, let me do one rapid fire with all of you in terms of the February MPC action. Upasna, rate cut, February MPC?
Yes, but it's a close call. Yes.
Okay. Kaushik?
Yeah, we have a 25 basis points rate cut call.
Prasanna?
Yeah, it's a very close call, Latha, but I would go with a 25 basis point cut.
Okay, so 3-0 in terms of in favor of a cut. In any case, the MPC already was at 4.2 in terms of expecting the cut. But Prasanna, what will that do to bond yields? By the end of March 31, can bond yields, if repo is 6.25, do yields go down towards 6.5?
So I think, Latha, for bond markets, while we may all concur with a 25 basis point rate cut estimate right now, bond markets are obviously comprised of a lot of participants where half of them might not even believe in the rate cut theory at this point of time because it's a close call, like I said. I think the argument for a rate cut is predominantly from the fact that the growth needs a support and current account deficit is still not a problem, though BOP is a problem. So rates is not the way to, protect the currency. And like you said, you need to let the rupee depreciate. But having said all this, we really don't know what is the thinking in the minds of the RBI, with especially two critical members being new. I mean, the governor and, of course, the deputy governor who would be new when the policy comes out. So from that perspective, market is still grappling with whether there is a rate cut or not. So I would presume that we would go with a range of something like 665 to 680 kind of a range till February. Of course, a lot of things ahead of February, what happens to Trump policy announcements, what happens to our own budget prior to the policy, and what happens to the Fed minutes? Do they indicate something different? So a lot of things are there. So I would say 665 to 680. But if I have to go with the fact that we are on balance expecting a rate cut in February, I would say bond yields are headed towards 665 to 670 by end of March.
Okay. If there is a rate cut, 665. Is that your call?
That's right.
Okay. Well, Kaushik, the noise that we have heard from North Block is clearly pressuring the Reserve Bank. I mean, the November report, which was announced on December, the monthly review, clearly seemed to blame Reserve Bank for the slowdown. There may be a lot of debates on both sides of that statement. But given that pressure, you still think there can be a close call on the rate cut in February?
Latha, let me make 2 points over here. Analytically, if you see a framework in the last 20 years, the different monetary easing cycles, the pause period between the end of a rate cut cycle, a rate hike cycle, and the start of a rate cut cycle, the highest gestation period has been 11 months in 2 episodes. So compared to the 11 months or a year gestation gap, this time we have waited for almost 2 years before the start of a rate cut cycle. So I would assume some part of the liquidity tightening as well as the rate hike and the long gestation gap, macroprudential norms have started taking effect on growth, and this is what we expected for FY25. So we are not surprised with growth having slowed down, and you're going towards 6.5% level, which is below potential. So I think the second point related to this is that monetary policy has to be forward-looking. If you look at the monthly bulletin that RBI has taken out in December, and if you look at the forecast that they have given for growth and inflation, you'll see that in October, December, and January, March, they're forecasting growth to be 6%. If you look a little forward ahead, and if you look at inflation, from July, September, they're saying inflation would be below 4%, 3.7, and then below 4% throughout. So if you know that monetary transmission works with some lag, 2-3 quarters, then you have to start the rate cutting process now itself.
Yes.
So you can't delay that, and then you'll be further behind the curve. So I think that's why February and April, 25 basis points rate cuts make a lot of sense, and then letting it transmit to the real economy.
Okay, very quickly, Prasanna, out of time on the first segment, though I have more questions. Why are you all going with only a 2% depreciation in the current year? It's a far more riotous year in terms of trade wars. Should we not have at least a depreciation that we had last year, 3%, which means at least 87.5 or 88?
Yeah, you're right, Latha. I think 2 to 3% depreciation on the INR is par for the course normally. But the way we have seen the Reserve Bank protecting the rupee in the past, makes us kind of be cautious in our estimate for the future as well, because we still, while we have seen a little bit of a change in the strategy of RBI in the way they protect INR in the last 15 days to 30 days, we still need to see what happens in a more volatile kind of a scenario. We still need to see what happens to yuan, because that's the joker in the pack. So yes, I would say 2% is a conservative estimate, but we are free to revise the stance as we go forward when we see more action from both China as well as from the governor.
Okay, well, I just want to leave the wrap up this segment with the understanding that, we must first of all stop giving a negative view to the rupee adjusting lower, because that is good for a large part of the domestic economy that's competing, as well as for our exports. On that note, wrap up on the first segment. There's lots more lined up on Indianomics in terms of how our experts see the current account deficit, exports, and the global headwinds shaping up. Back after the break.